Ladies and gentlemen, welcome to tonight's main event.
And right now we have our main event, which is Jeff Gentian, who happens to be a repeat offender. I think this is either your third or fourth time on the CSI radio show. I do want to welcome Jeff into the CSI studios. Jeff is the owner of Faustrian, is it Business Capital, Business Solutions, all-around good guy. What is
Business Capital, Kevin.
Business
Congratulations, you got it right this time.
I've been working all week on it.
Hey, I wanted to ask you, is this sweeps week for you guys?
Why is that?
Because that's usually when you ask me to be on the show, is when you need your ratings to be up there.
Yeah, we need the ratings to shoot sky high, and we do know that you email your whole database and let them know that you're going to be out here. And to the three listeners out there, I do want to welcome you to the CSI show.
Well, I definitely need to talk to my agent about increasing the fee that we charge you for me to be on here. But anyway, I'm glad to do it.
Absolutely. I probably didn't tell you, but actually you're required to make a nice, healthy donation to the Lockport Rotary Club tonight for our ice cream social.
If I show up, I suppose that would be a pretty nice donation, huh?
Absolutely. Well, hey, I wanted to have you on because your last letter, Jeff sends out a quarterly letter, and you referenced Japan, which I found very interesting because one of the most recent books I bought from Barnes & Noble is Japan from 1980 to current. And I've put out in writings, I think I've even put it on the show before, the phrase turning Japanese. And a lot of people probably don't realize that we have some pretty strong parallels from what's happening to our economy now and basically what happened from World War II to the current with Japan. So, maybe you could give us a brief, what I call the 1,000-foot macro view, of what happened then and the parallels that we have with our economy.
Yeah, thanks, Kevin. I think the story of Japan since World War II is an amazing one. In a half a century, this country's economy rose probably faster than any economy ever has, or at least it's up there, and then its fall was just as dramatic. This is a country that between 1960 and 1985 had a growth rate that was 3 times that of the United States. I mean, that's 3 times annually over a 25-year period. In 1960, its economy was 10% the size of the United States, and by 1990, it was 67%. I mean, that's amazing.
And there was talk, I believe, back then of Japan overcoming the U.S. to be the number one economy out there in the world.
Yeah, well, absolutely, and we'll talk about that in a minute or so. But basically, this is a country that went from being a war-torn, small island nation with few natural resources to having the second largest economy in the world in just a 30-year time frame. What happened, though, things reversed themselves in around 85 to 90. What happened was the yen appreciated against the dollar. In response to that, the Japanese government implemented a kind of a hyper-aggressive monetary policy that, in effect, created, within a 5-year time frame, probably the greatest asset bubble the world's ever seen by 1990. In response to this asset bubble, the Japanese kind of contracted, I guess, their monetary policy probably too abruptly. And what they did was they popped this bubble, and, in the following 20 years, the decline in values of Japanese stocks, real estate, etc., was probably as precipitous a decline as we've ever seen. What happened was obviously the banks' collateral values were crushed. Banks froze lending. Deflation hit the economy, racked the economy. The Nikkei decreased in value percent by 2003.
And the Nikkei, for those that don't know, that's their version of our S&P 500. So the Nikkei is the stock market there, and yes, it lost 80%.
Yeah, 80%. I mean,
that's a hell of a loss to look at your statement and see.
It's a hell of a loss. And, housing prices were down 90% by 2004. This is not a year. This is a 15-year period. Real estate, commercial real estate values were down 99%. All told, there was $20 trillion in loss of asset value in the Japanese economy during this time period. And the thing is and this is the point, it's been 20 years and Japan is still reeling and they still have not emerged. So the point here is that we have a case study sitting right in front of us that we can go to school on as to see what maybe not to do to emerge or to pull ourselves out of the recession that we're in, and we need to use it, in my opinion.
Yeah, because Japan, I mean, it was going gangbusters there for quite some time, and like we said, it looked like it was going to overtake the U.S., and then it literally fell off the earth when this bubble, like you said, just popped, and it was one of those things where during the 90s, when we were experiencing this massive growth with the internet and broadband and all that, Japan's 90s are known as a lost decade. And you're right, we have an excellent example sitting in front of us in regards to, taking a look to say, hey, this is what Japan did. And part of the fear I think that a lot of people have is one of the first things Japan did was they cut their interest rates down to zero. And our interest rates are at zero right now. But unfortunately for Japan, I think they stayed there for about 12 years, and we're approaching 2 years now with our interest rates there, with no hope of them coming up anytime soon. So it's been there. And I don't know if you saw in the paper today, the New York Times had it, and it probably wasn't in the papers in the electronic version. China just leapfrogged Japan. The government came out and admitted it, or the statistics, I guess, proved it, that Japan was the number 2 economy, even though it popped afterwards. And now China actually is the number 2 economy. We're starting to get the same headlines almost, where they're, by 2030, I think they say now, China's going to overcome the U.S. for the largest economy. So it's pretty interesting to see a lot of these parallels kind of play out, 25 years later.
Absolutely.
So, but Japan obviously had this severe fall. What kind of lessons can we draw from, looking, like you said, at this case example, 20 years ahead of ours? Yeah,
I think there's a lot about this Japanese story, and obviously we're not going to cover it here in a few minutes, or even in my newsletter.
That's why you're here.
But, well, your audience is definitely getting an education, at least more so than they usually do.
Oh, boy.
But I think what my purpose is, I think there's 3 or 4 fundamental lessons that we can learn, I think, that are indisputable. The first is that a government should not implement policies that create an asset bubble. Japan did it clearly with their aggressive monetary policy in the late 80s, and we have to acknowledge that our government has done the same thing through the support of Fannie Mae, Freddie Mac, FHA, mortgage insurance, certain HUD policies, the Community Reinvestment Act, an expansive Fed policy. All these things were complicit in creating our housing bubble that eventually bursted and caused us to go into the recession that we're in. So we must acknowledge that, and we need to learn that lesson. I think the second thing is deficit spending. If you look at Japan racked up enormous deficits over this 20-year period. The consensus is, looking back, that these deficits, the purpose of them was obviously to stimulate the economy, but looking back, I think the consensus is of economists that the deficits did no good, virtually nothing. But what they did do was increase Japan's debt to gross domestic product ratio from 70% in 1989 to 225% today. Now, those in the know about debt, that's an enormous debt load that will fundamentally be a cancer to Japan's attempt at recovery for many, many years to come.
Yeah, and to put that in perspective, we freaked out this summer about Greece, which was sitting at about 120 and 125% debt to GDP level, and Japan's sitting at over 200%. But no one's talking about it.
Well, it's a case study. We would be, it would be terrible if we didn't learn from the Japanese case study. With the United States, we're on the same path that Japan was on, but we're early in the journey, and we still have time to change course. But we need to look at what happened with Japan in regard to deficits and go to school on that. I think the third thing, and this is a big one, is that we need to have the guts to allow failing businesses to fail. What Japan did in their attempt at recovery, they bailed out their banks with a condition put on the banks that the banks were required to lend to failing businesses. Now, this is a terrible thing for really 3 reasons. Number one, you need to, when a business is failing, their assets need to redeploy to stakeholders that are going to optimally utilize those assets. That's good for the economy. Number two, when you subsidize and prop up dying businesses. They're called zombie businesses in Japan. You necessarily are suffocating the good businesses those zombie businesses are competing with. And thirdly, the loans that these Japanese banks were required to make have now, most of them, gone bad. And that, many years into Japan's attempt at recovery, has become a new problem and actually has become probably Japan's biggest problem they got right now. And the last lesson quickly is that tax increases. Japan raised its consumption tax from 3 to 5% in 1997 to try to start paying down its debt. And it was disastrous to the Japanese economy. We need to go to school on that too.
So, and then we're going to take a short commercial break, and when we come back, we're going to talk to Jeff more. But one of the things I want to follow up on is the banking industry, and then specifically, I think what you're doing out there is a little bit unique. Even though you've been on a couple times, I think each time you come on, it's probably even more needed and more necessary. So probably more and more people might be tuning into the message that you have out there, because there obviously are people out there that are willing to help the banks and stuff that don't have to necessarily rely on the federal handouts that have been given out. So we're going to take a quick 90-second break, and when we come back, we're going to continue talking with Jeff Gentian, the owner of Faustrian Business Capital.
Kevin Clark is an investment advisor representative and offers securities through Next Financial Group, Inc., member FINRA, SIPC, 401k Confidence, and other investment advisory services offered through Independent Solutions Wealth Management, LLC, a registered investment advisor. Office is located at 6631 Main Street, Williamsville, New York, 14221, 716-633-1515. QRS, Inc. is located at 900 South State Street, Lockport, Illinois. Neither QRS, Inc. nor Independent Solutions Wealth Management is affiliated or controlled by Next Financial Group, Inc.
A crisis in Europe. Stocks are up one day and down the next. Volatility has returned to the stock markets with a passion. Hi, I'm Kevin Clark, creator of 401k Confidence. 401k Confidence is a service that will provide you with customized monthly advice on how to position your 401k plan. Professional advice on your 401k plan is just one click away. Go to qrsinc.net and click on the 401k Confidence tab. There you can learn more, download a sample report, and print out the forms you need to set up your account if you're interested. 401k Confidence is only $19.99 per month, and there are no long-term contracts. 401k Confidence begins with a visit to qrsinc.net. That's qrsinc.net.
The WJOL Ask the Professional series is proud to bring you CSI, Common Sense Investing, with your host, Kevin Clark, owner of Quintessential Retirement Services and the creator of 401k Confidence. And here's your host, Kevin Clark.
Welcome back. You are listening to CSI, Common Sense Investing, with me, Kevin Clark. And we're sitting here talking to Jeff Gentian, who's the owner of Faustrian Business Capital. We just did a slight recap on what happened to Japan, basically from the 1990s on, how they were the most powerful steam engine, if you will, plowing up to overtake the U.S. economy, and then they fell off the face of the earth and things just stalled when they had an asset bubble. They had real estate lose massively. They had their stock market lose massively. The economy came to a screeching halt. The government intervened. They made banks lend. There was a whole what we call zombie banking system that was put into play. And yet somehow, and this is me saying this, not Jeff, you might want to chime in, we're arrogant enough as Americans to think that this may not happen to us because we're the good old U.S. of A. And I just only hope and pray that the politicians and the people in charge right now of the fiscal policy, they are looking to Japan. You know, it's one thing to look at our own U.S. Depression that occurred here in the 1930s. It's another thing to look in the 80s when we had sky-high inflation and all that. But right now we don't have sky-high inflation. We got interest rates at zero, and that's exactly where Japan started from when their bubble burst. So I hope that they're taking a look